So, welcome one and all. I do apologise for the slightly later start due to some technical difficulties at our end, which have just been sorted. So, thank you for hanging in there, and I appreciate it. Now, a lot of people won't be coming on because it's in the middle of the day and they're busy and all that sort of stuff, which is cool. Those of you that are coming on, thank you very much for giving up your time and attending and listening. And for those majority of you who are listening later on, for those of you that are listening later on, which will be the majority of you, please, I'm going to go at a pretty rapid pace. So please feel free to listen to this again or pause and listen at your leisure. But what I wanted to do was I wanted to go through, revisit the pros and cons or just the basics and fundamentals of how property bought in self-managed super fund, how it can be extraordinarily powerful to help maximise your retirement. But also I'm going to go through today a lot of slides about how super fund works, how a bare trust works, how it all works and why you should consider it. But then I want to go through and explain why the clock's ticking and why this is more urgent than ever before, that if you're going to do this, that you need to do it like literally straight away. So I'll get into it. If anyone's got any questions, please feel free to shoot a question in at any stage. As I said, I'm going to go fairly quickly because there's a lot to cover and you guys can listen to it later on because we'll send you out a link with the whole presentation later on. So I'll get right into it. Superior Super Solutions, our main aim is to make sure that each of you out there maximises your retirement and whilst minimising how much administration you guys have to endure at your end along the way. Now, I wanted to start explaining and asking a question. Asking a question. How many of you out there would like extra money for retirement? Now, I know it should all be, yes, we do. I want it. I want a lot more money for retirement because there's never enough money for retirement. And I want you to go through this example with me, which I'm just about to go through. I want to really go through and explain how, and a lot of you guys might get this, so please forgive me, but I want to revisit it and I want to go over it to really get your head around the super side of it. But the power of leverage with property is extraordinary, and it can also be extraordinary in self-managed super funds. So imagine an example where you've got 200 grand to invest between yourself and your partner and potentially 2 other family members. It's 4 members at the moment, but I know it's before Parliament at the moment to increase that. But because that's not law, I wasn't going to go there. You can have up to 4 members at the moment, family, blood, relatives. But let's say it's just yourself and your partner. You need 200 grand between you as a rule of thumb. And let's say you invest that over 20 years. And let's say you do it under 2 scenarios. Scenario 1, you invest 170 grand in because you keep some in cash, in a mixture of shares and managed funds. And let's say it doubles every 10 years in shares and managed funds, which I know is extremely questionable. But let's work on that for the purposes of this example. And let's say you also then compare that to investing in property via borrowing inside a self-managed super fund. So your 170 grand you could use to buy a property for $450,000. And let's say you borrow 70%, 315,000, and the super pays for 135 towards the purchase plus other costs and setup costs and stamp duties, etc. is 170 grand. So let's say with property that you keep it for 20 years, and like with the shares and managed funds, it doubles every 10 years. So what that means is your $450,000 property would double to 900 and then double again to 1.8 million in 20 years time. Now, if you take off what you bought the property for, which was 450,000, that means there would be a staggering gross capital gain of $1.35 million. Assuming you pay 10% tax, which I'll cover a bit later on, that means you're going to pay 135 in capital gains tax. And that means the extra money for retirement is effectively $1.35 million, which is $1.8 million proceeds, less paying back the $315,000 of debt, as you can see there, and less the tax of $135,000. That means the extra money you now have for retirement in 20 years' time after tax is $1.35 million. So let's go to the next slide. So what does $170,000 get you with the shares and managed funds example? So once again, let's assume it doubles goes to 340 and then to 680 over 20 years. That means the gross capital gain is $510,000, tax of 10%, 51. That means the extra money for retirement would be $629,000. The most important thing is this slide. Because of the power of leverage, using the scenario that I've just painted and the power of leverage, after 20 years, by having a property for 20 years with borrowed funds, it could provide you and your family with an extra $721,000 for retirement after tax. I don't know about you, but that's staggering and that's game changing. So this is why I wanted to revisit this, because the power of leverage is extraordinary and it's also powerful inside of super. So just between those two different scenarios, it can make up to a $721,000 difference on a $450,000 property. So you could imagine if you had more in super and you could buy a bigger property that might be in a better location potentially and grow, etc., that compounds that figure. So it could be exponentially higher. I've used it based on a $450,000 property. So that's the first part of this webinar was just to explain how powerful leverage is and what massive difference it makes for retirement. So the next part I wanted to cover was to just go through some basics of self-managed super funds. And I do apologise if some of you guys know this, but there are going to be plenty of people listening to this who don't have a self-managed super fund. So I wanted to take them through some parameters around how this all works. So with a self-managed super fund, you can basically manage your own super, and you and your partner are the trustees of the super fund and invest the assets for the members. And as I said already, there's 4 or fewer members. The members must act as trustees. As a trustee, you cannot pay yourself for being a trustee from your self-managed super fund. It takes around about 1 to 2 weeks to actually set everything up, but up to 28 days it does to get the ATO to issue the tax file number and ABN. Now, we prefer a corporate trustee of your self-managed super fund, and that's for 2 reasons, but the main reason is for estate planning purposes. If you have 2 individual trustees and someone passes away, you can't function the super fund anymore with of only one person. And to be a trustee or to be a director of a corporate trustee, you have to be over 18 years of age as well and be legally able to be an adult and legally sign documentation and things. So with a corporate trustee, you can also be a single member fund. So in other words, it could be just you and you've got enough super and you can do this with a corporate trustee. Now, if you do a corporate trustee, then each member must be a director and shareholder of the company. And the other part to mention about corporate trustee is for estate planning purposes is another reason why it's needed. The sole purpose of this fund can only be to provide for retirement for the members, for no other purpose. As I said already, a super fund can be set up with 1 member. As a trustee, when you set up a self-managed super fund, a deed sets it up with all the rules and regulations around the setting up and running of the fund, and you must abide by the fund's deed. And any money that belongs to the super fund is not your money. It is the self-managed super fund's money for the member. And you can only ever pull money out of a self-managed super fund, which I'm not going to cover today, when you meet a condition of release to be able to pull money out. Otherwise, it is a serious offence and is actually potentially finable and even jailable if you do not abide by the rules. The main types of contributions that come into a super fund, the one that everyone knows about is employer contributions at 9.5%. And then you can potentially salary sacrifice as well. So, up to 25 grand can go into a self-managed super fund each year per member, tax deductible, that is. Now, if your employer contributions is only put in, 10 grand during a year, you can actually top up during a year 15 grand as well. But look, I'm not saying advocating just going and doing that. I'm just saying salary sacrifice is a way of topping up your employer contributions, but that should be discussed before you do it, whether it's suitable, appropriate for your circumstances, etc., etc. I'm only very much generalising. And then there's various other bits and pieces, including rollovers down the bottom. A self-managed super fund can accept a rollover of your, like if you've got an industry fund, which most of you will have if you haven't got a self-managed super fund, a self-managed super fund will basically get a rollover from your fund to help provide the funds to invest and do what you need to do inside your newly established self-managed super fund. Reporting obligations. Every year, the self-managed super fund must prepare financials and tax return and lodge with the ATO, just like you do with your own returns. And that the only difference with a self-managed super fund is the financials and tax return must be audited every year. Now, obviously, we take care of all that, so you don't need to worry about that. But it's just to let you know the obligations. All self-managed super funds also must have an investment strategy, which is in writing and signed, and should be reviewed, well, if not every year, very regularly. Also, the ATO charge, like they do for a lot of things, the super fund, they charge you $259 yearly levy that you pay them when you lodge your tax return. First year levy is $518, and the reason they do that is if you ever wind up your self-managed super fund, the last year that you wind up in, you don't pay the levy. So they get you 2 years up front, and basically if you ever wind up, the year you wind up, you won't have to pay the $259. And as a trustee and a member, it's important that you keep all of the following records for at least 10 years. Things like minutes, changes of trustees, declaration, consents, everything that should be in your binders that set up your company, corporate trustee and the self-managed super fund that's filed in there. You need to keep that for a minimum of 10 years, but I would argue you'll keep it permanently because it's easy to do because it's all in there. Tax. I said I'd cover tax a bit later. Super funds are taxed at the rate of 15% flat on their income. And as I touched on earlier with my example of leverage, if a self-managed super fund sells an asset that it's owned for more than 12 months, capital gains tax is paid at the rate of 10%, which is a 1/3 reduction. Now, just pausing there for a minute. For all of you guys out there that would know or probably know that if you own a share or a managed fund or a property, either personally or in a discretionary trust, that when you own it for more than 12 months and incur a capital gain, that you get a 50% discount. In a self-managed super fund, you get a 33 1/3% discount, so it drops the tax rate down from 15 down to 10. Now, I don't know how many of you out there would be pretty happy to pay tax at 15% anyway. I think we all would be. Self-managed super funds are the most tax-effective way of having anything. The only negative, one of the negatives about self-managed super funds is you can't get money out of it. You've got to invest until you're able to effectively retire legally and pull the money out, or transition to retirement and pull the money out. But if you're going to invest and you've got super anyway, then why not potentially consider what I'm discussing today and get more bang for your buck, which is why I'm covering this. Now, if the self-managed super fund is in pension mode when it sells the asset, then there'll be no tax payable at all on the capital gain. Now, if your gross rent, so you've got a rental property in there, if your gross rent, taking off your interest, taking off your other costs and depreciation is either zero or a loss, the loss can be carried forward to next year. Or it can be offset against the super contributions that come in, because super contributions that come in from your employer or that you're a salary sacrifice get taxed at 15%. But if your property happens to be negative in your super fund because of depreciation or whatever, then the contributions coming in can be offset. The 15% tax can be offset somewhat by any potential negative gearing as well, which is a small benefit. And no, as I said before, no capital gains or losses are occurred when you're in pension mode. Now, Bare Trust. That was the basics of a self-managed super fund. It sounds complicated, but the reality is, because we hold your hand through all of this, you really don't need to know the A to Z of it all. You just need to know the very basics of it, and more so the core benefit of what you're doing it for, and let us help you with everything else. So you don't need to overstress all this. Now, the reason a lot of you probably haven't heard of Bare Trusts. Bare Trust is basically was brought in when the government brought in the rules that allow you to buy property in a self-managed super fund and borrow. They brought in Bare Trust obligations as well. Now, I'm going to cover what a Bare Trust is shortly, but it's basically, you don't need to get too concerned. It's basically the mechanics. If you want to do it, this is how you have to do it, because this is the way the government, if you want to go in, this is how you have to do it. And once again, you don't have to get too concerned with this, because this does get quite confusing, because we will handle it all for you. So you do not need to worry. Very little of it falls back onto you. It's more focusing on the benefits of why you're doing this. Now, a Bare Trust is basically a mechanism that allows your super fund to buy property with debt. The property's legal title will actually be held by the Bare Trust until either the loan is repaid or until the property is sold. And the self-managed super fund is the beneficial owner, which I'll explain more in coming slides. What loans are available for in the self-managed super fund environment? They're only for investment purposes, refinances potentially, and loans are only securable by first mortgage. Refinances might be difficult because there's less lenders in the space than what there was, a year ago. But the core benefit still exists, even if there's not as many lenders as what there was. What loans are not available for? You can't buy an owner-occupied property inside a super fund. You can't borrow to renovate or repair or improve. You can't, unlike outside of super, when you get equity, you can actually redraw that equity and go and buy again and go again. You can't do that. You can't get increases or get equity out. And the other thing you can't do, which you can do outside of super, is outside of super, it's very common if you buy a new property to settle the land and then have progress claims for the build. Now, inside of super, you can't have progress claims. So what it means is if you buy a new property inside of super, it has to be all packaged up, land and house, into one contract and no progress claims. So effectively 10% down and balance on settlement is all you can do inside of self-managed super funds. Other key considerations with regards to the loans. The self-managed super fund is the one that borrows the money and pays back the interest and principal. And the loan can purchase a single asset plus acquisition costs like legals and stamp duty. And the asset that you're buying has to be one that a super fund can buy. For example, residential property not currently owned by members. You can't buy a property from yourself in a self-managed super fund. I won't go into all that now. There are some exceptions, but I'm not going to go into that. So for instance, if you liked a residential property that you owned in your own name, that you lived in, or that you had an investment property outside of super, you cannot sell that to yourself. It's forbidden under the rules. There are some exceptions, but I'm not going to go into that. That's beyond the scope of this webinar. Other things to consider with the loan: it's non-recourse. That means in default, the lender can only sell the asset that you bought. Generally speaking, the interest rates are higher for self-managed super fund products, anywhere from 1% to 2% higher, potentially. Loan to value ratios are anywhere from 60 to 80%. You can still get an 80% lend, it's just a little bit harder. It's very common these days for lenders to have postcode restrictions for where you're buying your property. And there may be some caching requirements that you need to satisfy with the lender after you buy the property and settle the property. And it is very common these days that you need a minimum of 200 grand for a lender to consider a self-managed super fund loan. Now, we still consider it best practice to not have signed personal guarantees, but it may not be possible. If that's the case, don't worry about it. You've still got to do it. Now, obviously, with the main issue is there's postcode restrictions and the interest rates. Now, with interest rates, there are fixed rates available still, but they're still higher than the fixed rates you'd have outside of super. And you just factor that into your overall holding costs. So, you know, in my example before, where your 450, you know, became 1.8 million over 20 years, even if you're paying 1 or 2% higher interest rate, if you do the maths, you're going to be miles in front, even if you have a higher interest rate compared to what you've got out of it over the 20 years by the capital gain and the extra retirement nest egg. You know, $315,000 loan, even if it's 2%, that's $6,000 a year. 20 years, $6,000, that, you know, that's 120 grand, but you've gone up, what was it, 1.35 million. So you're still massively in front. You've just got to factor that into your holding costs. That's all. But the benefit still far outweighs even with higher interest rates, given it going up in value and things, you know what I mean, like I spoke about already. Other things relating to the Bear Trust. The asset bought is held by the trust, while, as I said, while the loan is being repaid. The Bear Trust has to have a corporate trustee. And once again, all members of the super fund must be directors and shareholders. This company cannot trade. It's important that it doesn't. And a really important point, under the law, the trustee of the super fund must be different to the trustee of the Bear Trust. So what that means is you need a separate company to be the trustee of the super fund, to be a separate company to be trustee of the Bear Trust. That is legally required. There's no way around that. And it's important that the Bear Trust plays no other role other than owning the property, nothing more. And, you know, to summarise in a picture sense, your self-managed super fund has ABC Proprietary Limited with 3 directors and 3 shareholders who are members, and XYZ Proprietary Limited would be trustee for the Bear Trust with the same 3 as shareholders, directors, who are the members. That's the legal requirement in a snapshot. Other things in relation to the Bear Trust, there's no bank account, no tax file number, no tax return. It has to be inactive, and there's no GST registration, because the idea of a Bear Trust is it does nothing at all except own the property for the super fund. Remember, the Bear Trust, they don't benefit. The Bear Trust doesn't benefit from the super fund, from the property. The super fund still benefits from the property even though it doesn't own it, because the Bear Trust owns it for the super fund. Who signs the contract? Each state has different legal requirements on purchasing properties in Bear Trusts and things. Once again, it's the trustee of the Bear Trust who buys the property legal, and it's really, really important to seek accounting advice and legal advice before you sign any contracts involving a Bear Trust. Now, I'm going to go through it. One thing I'll say about this whole self-managed super fund and Bear Trust and borrowing and gearing and all that through super fund, it's awesome, but it's very complicated, and there's not a lot of people out there who fully understand this whole process. And if you do not do every step of this right, it can come back and have a massive sting in the tail. So it is essential that you don't just go there, beauty, I'm going to go and set up a self-managed super fund and go and buy a property. Nope. That's the biggest mistake you could ever make. You need to seek the advice of an expert who works in this field every day of the week, like us, and does this every day of the week and lives and breathes it, because there's so many little details that you need to dot the I's and cross the T's with, and things have to be done in certain orders or it comes back and bites you in the bum. So it's really important you get proper accounting advice and legal advice before you go ahead and do anything. Because if the name on the purchase contract is noted correctly and the Bear Trust and deed is set up and signed correctly, then stamp duty should be only charged once. If you do this wrong, it could be potentially charged more than once and potentially trigger capital gains more than once. So it's really, really important, as I said, to get advice before you do anything. Before you sign a contract, before you do a thing. Lease agreements. If you get to rent your property out, clearly, when you finish and settle it, the Bear Trust should be the one that's named on the lease. The property agent would pay the rent straight to the super fund. Our preference is to go for monthly statements, and our preference for administration for you guys is if the agent's happy to pay running costs like council rates, water rates, insurance, etc., then get them to do it out of the rent. It's so much easier for you guys and makes the substantiation a lot easier as well. Insurance. The requirements of insurers do vary. Now, if the insurer requires the policy to be in the name of the Bear Trust, then the policy should record that the super fund is the beneficial owner still of the property. All premiums for insurance would be paid by the super fund, and obviously, like all insurance policies, the policy should note that the lender has a financial interest in the property, which would be standard practice. They wouldn't let you settle the property without having that noted and having a certificate of currency on the insurance for the property, which is no different in and outside of super, that side of it. Other general considerations: the super fund receives the monthly rent, and the super fund pays all the running costs that a normal landlord has, such as interest, council rates, insurance, water rates, body corporate fees, commission, repairs, etc. And if the property does get sold, then any capital gains tax is payable by the super fund itself. So as you can see, the Bear Trust really doesn't have any role other than owning the property. Everything else, all the ins and outs, are really the super funds. And as I said, I discussed capital gains tax rates earlier in my slides. Now, a self-managed super fund can also claim depreciation, just like outside of super. And please get a quantity surveyor, obviously, to work that out. There's only one decent quantity surveyor in Australia, and happy to put their details onto you if and when you're ready. The only thing that changes now, because of the change in the rules that the government brought in the budget, I think it was May last year, if you buy a brand spanking new rental property, right, that has not been rented before, then you can get a quantity surveyor to work out the depreciation, and those depreciation entitlements will be huge, and they will do obviously all the hardcore claims like your plumbing, electrical, roofs, slabs, etc. Right? No problems. But you're also entitled to claim the fixtures and fittings components of that as well. If you've bought something, so part B of this is if you've bought, this is the new rules, if you've actually bought something that's been rented before, you're not able to claim any depreciation on the fixtures and fittings, but you are still able to claim your share of what's left on the hardcore capital works deductions. So what I mean by that is, if something's built, there's two main types of costs. There's your fixtures and fittings like your carpets, curtains, light fittings, stoves, oven, hot plates, dishwasher, all that sort of stuff, right? And then there's your other bits and pieces, like I mentioned before, which is roofs, slabs, timber, plumbing, electrical, all that sort of stuff, right? All the really big ticket items that last a long time. Those claims are written off over 40 years. Now, if you buy it new, you get both of those, no dramas. But if you buy something that's been rented before, you don't get the fixture and fitting element, but you still get what's left of the 40 years. So if someone's claimed the building write-off for 5 years, you still get to claim the remaining 35, even though the property's been rented. So don't rule out getting a quantity surveyor. If it's been built in the relevant years, which off the top of my head is after 85 or thereabouts, if it's been built after about 85, there's still highly probably a share of the building write-off that you're eligible to get, even if you can't get a share of the fixtures and fittings. Now, if it's close to 85, then I would suggest you consult the quantity surveyor before you go ahead with it to make sure it's viable. But if it's been built in the last 15, 20 years, there's still going to be at least 20 years on the clock that you can depreciate. So it's definitely going to be worth getting a quantity surveyor's report. And while we're on the changes, the other thing that's changed in the recent times is you can no longer claim a travel expense to inspect or repair your rental property. They outlawed that in budget. I think it was May last year as well. Now, I've covered some basic lender requirements. I consulted my personal broker, who was also a broker for a lot of our clients. And if you want her details, please shoot in your, and I'll pass it on. But what she did is she gave me 2 lenders and where the parameters are at right now in terms of their lending criteria. I've covered some basic stuff, but this is exactly, so lender 1, you can get a loan to value ratio of between 60 to 80%, subject to what postcode you're buying in and what type of security. So in other words, whether it's commercial or residential. This lender does not look at your assets and liabilities outside of super. They do require 20% of what you're rolling into the fund to be left over after you settle the property. And the minimum loan is 100 grand. To give you an idea on rates, the variable rate is 5.99 P&I or 6.49 interest only, up to a 30-year loan term, which, as you know, is somewhere between 1% to 2% higher than the market. For servicing, they only rely on your self-managed super fund contributions plus 80% of the rental income. They will not look at your financial situation outside of super, which is really important because some do. And the bank will only accept the lower of the last 2 years' contributions into super. And it's the same whether you're a PAYG, so an employee, or whether you're running your own business. And the fees are around about $1,200 to set it up and about $10 a month. So that's lender 1. Lender 2, fees are a bit higher, around 4 grand. Interest rates, it's variable up to 65% loan to value at 5.09 and up to 6.19, 75% of P&I, and then you add 1% for interest only. Liquidity, they need 7.45% of whatever you're borrowing after settlement with a minimum super fund size of 120. So that's a little bit lower than before. For servicing, they take 80% of the rental and 2 years contributions and tax returns if you're self-employed, and they take 9.5% for employees. Still need to provide 2 years worth of statements and contributions and pay slips, etc. And loan to value ratios are determined by what type of property, residential and commercial, and what postcode you're buying in. So look, they're not dissimilar. They're just, up on some, down on others. Just to give you an idea, there's not a lot of lenders left in this space. And when I summarise, you'll probably understand why. There was a lot more lenders in this space 2 years ago. And in the last 6 months, I know of 2 or 3 lenders who have pulled out. Now, it doesn't mean it's not viable anymore. That's just their banking, the banks have made those decisions that they're not going to do anymore in that market. Like over the years, there's been plenty of lenders who've pulled out of the investment space at different times in totality, in or outside of super. And there's, the whole host of different things that go on out there in the lending environment. Just because they're pulling out of super does not mean it's not a viable option. It absolutely is. But the bank has made their own decisions that they're moving their eggs from here to here or from here to here. But as I said, I do know examples where banks have pulled out of investing total, like they won't lend to investors at different stages. And so now the next phase, there are still lenders, is what I'm saying. You can still get this done. It's just there's less options available. But it still makes it extraordinarily viable, even with everything I've covered today, based on what it adds to retirement via leverage. So I'm going to talk you through, now I don't want you to get scared by this. I'm going to talk you through the full process of a self-managed super fund, but I want you to understand one thing. The majority of these points we either do for you or we hold your hand so that we'll guide you on what you need. You do not need to be intimidated by this because there is nothing that's scary in this that you have to do. The majority of the scary stuff is done by the lender, done by us, or we hold your hand. So I'm going to still take you through it so you understand the process. Okay, first step is to obtain pre-approval for the loan from a financier, and hopefully, if you can, get it in either a pre-approval, or an indicative approval. That way you can ensure that, is it viable, is it going to work, and that way ensuring that between your loan and whatever you've got in self-managed, between what the bank's going to give you as a loan and what you're going to roll in from your industry fund between you and your partner, will give you enough funds to buy the property, including all the setup costs, stamp duty and lender's costs, etc. Next, we will prepare a statement of advice to ensure that the self-managed super fund is viable if you don't have a super fund already in existence. We obviously not required if you don't have to do this if you've already got a super fund, but if you've only got industry money and you don't have a self-managed super fund, then a statement of advice is a requirement now legally that we have to prepare for you to make sure it's viable and gets signed off by our licensee, because we report to another body who signs off. Then if you don't have a super fund, you then set up a super fund, ensuring that it has the power to borrow and buy a property, and that takes about 1 to 2 weeks. And once a super fund's established, then you can arrange to roll over your current super into your new super fund's bank account, being careful not to roll over your funds 100% out, because I'll tell you what can happen. Let's say you've got, one of you's got 120 grand in care, right? But care also has life insurance and income protection insurance through your fund, right? So, because you're about to go and buy a property and borrow to do it, and you've got insurance already, you obviously want to make sure that you keep the insurance going in the new self-managed super fund. But the way that works is, we would find out from you how much care needs to keep your insurance live, which off the top of my head is about 5 grand. It varies per fund from, $1,500 to 10 grand or somewhere in between there. But let's say it's 5 grand, and let's say you've got 120. What 0.4 is talking about is, we want to make sure that you only roll out, say, 115 grand out of your 120 into your new self-managed super fund bank account. So you keep the 5 in the old fund, the old industry fund, to keep your insurance going. Because once you set up your self-managed super fund, part of the setup process would be to get new insurance in place, life insurance, income protection, TPD. You can't get trauma in a self-managed super fund, but you can get life insurance, income protection insurance, and TPD insurance, and they're all tax deductible to a self-managed super fund. Whereas a life insurance and TPD insurance outside of super is not deductible. Income protection is obviously deductible in or out of super, but life and TPD is not deductible outside of super. So you can hold 3 out of those 4 policies inside of super. You get them, the new policies set up and live in the name of the new self-managed super fund. And once they're live and active, you can roll over the balance of the 5 grand, so that then you've never been not covered on insurance at any point through the whole process. And that is really, really important. But we will help you through that. So don't worry, we help you roll over your money and advise you and all that to help you minimize the chance of that happening. Now, if you have an existing self-managed super fund, you've got to check the deed to make sure that the fund can borrow and buy a property. If the deed doesn't allow it, you then get it updated, deed done, which is a pretty easy process that we can help with. The fund then must have an investment strategy that it reviews and puts in place, and if needed, amend it. Then we need to establish the bare trust and the corporate trustee. Remember, because that buys the legal title to the property. It'll allow another 1 to 2 weeks. By the way, going back, it takes 1.3, it takes 1 to 2 weeks to set up a super fund. Remember, I said it might take up to 4 weeks to get the tax file number and an ABN. No rollover can be applied for until the TFN and ABN have been issued by the ATO. So you can't start the rollover process for around about 4 weeks, because that's how long the ATO takes to issue an ABN and TFN. Once you get an ABN and TFN, then we can start the rollover process. The rollover process itself, depending on who the money's with, can be as little as days or a few weeks, because some of the guys really drag their chain on allowing you to get the money out and getting the paperwork and getting it processed. But once again, we help with as much of this as we can. So going back to point 9, the bare trust and corporate trustee are then established and allow another 1 to 2 weeks. Then you find a suitable property, sign the contract and pay the relevant deposit from the super funds bank account, obviously after you've banked the rollover. So the key to this is you can't even think about buying a property until you've done steps 1 to 9. So you need to set up your super fund and corporate trustee. You need to apply a TFN and ABN, rollover, insurance, set up the bare trust, and the money's rolled in the bank account. And once that's happened, even if the insurance isn't fully live, we can still potentially sign a contract because it's not going to settle. I prefer to have the insurance set up if we can, but if some things are a bit more of a rush, as long as the insurance is set up prior to settlement, I think that'll cover off on all that. But the key to it is the deposit has to come from the super funds bank account. So you have to wait until after the rollover. So you really can't go shopping for a property until you've got everything set up and so at least your initial rollover. So in my example, the 115 grand out of the 120, if that's sitting in the account and the 5 grand's holding up waiting for the insurance to be put in place, that's okay. You can go shopping and potentially buy a property. Once again, make sure that you get advice before you sign any contracts, that the right names are put on the contract, etc., etc. Then we send the signed super fund deed and bare trust deed and a copy of the purchase contract for a solicitor and review to commence settlement of the property. And then if the lender requires anything else, then those documents are put together to facilitate the settlement of the loan in due course. At settlement, the loan will be provided by the bank. The balance of the money required comes from the super funds bank account, and the bare trust deed should be stamped at the same time as around about settlement, and the mortgage of the property is registered, and then after settlement, obviously the property gets rented out. So I've covered a lot of stuff. And I know I've rushed and all that sort of stuff, and I've done it intentionally because I'm mindful of people's time, but this is being taped and you're all going to get a copy of the link so you can take your time. If there's specific bits you want to listen, just, go back and listen to it a few times. Or if you want to listen to it all a few times, that's fine. What I want to reiterate is it sounds complicated. It is complicated, but from your point of view, it's not complicated because we at Superior Accounting Solutions and Superior Super Solutions, who is the standalone self-managed super fund business, we're 100% Australian owned and operated, and we are one of the few experts in Australia in property purchases in self-managed super funds and all the nuances and tricks of the trade and things to be aware of and traps and for the unwary and all that sort of stuff. So if you're going to do it with someone who knows what they're doing, so you're going to be looked after and you're not going to have anything come back and bite you in the arse down the track. But also I want to reiterate, everything I've covered today, you don't need to remember it. We do majority of it for you. There are little things you've got to do, but we'll help guide you through the process. And really, this process is quite seamless because we hold your hand through the whole thing. Obviously, we can't choose the property. That's your domain because it depends where you're looking and what you're looking at and what types of property and what locations and all that sort of stuff. And obviously, wherever you choose has to be governed by the lender as well because they've got restrictions on postcode and types of property. So that's really important that you speak to your lender as well before you hone in on certain locations. It might be wise to speak to your broker and go, all right, I'm looking in this area. Is that okay with the lenders you've got? Or is there any restrictions on the types of properties I can buy in these locations? And make sure you get an idea of the the location you're going to spend your time looking in, that the bank will give you the money because it's in the right postcode, and that the type of property you're looking at, the bank will give you the money for as well. And make sure it all stacks up before you start wasting your time looking for properties in those locations. But I want to reiterate that this is an incredible opportunity to use leveraged funds to massively improve and increase your retirement nest egg for you and your family. In my example I went through before, it was a staggering $721,000 after tax difference in your hands for retirement in 20 years. I don't know about you, But by God, I'd take that in a heartbeat. That is a massive difference just by doing something different and getting someone who's an expert in their field to help you, guide you through the process. The only other thing I really, really, really want to summarize, and this is why I'm going through this all again, is these rules have been around for a while, right? A few years. But if any of you guys out there are listening to the media and reading the paper and getting a vibe on social media, I obviously can't guarantee this, but everything's pointing to Labor getting in to power next election in Australia, which I don't know exactly when it's going to be, but it's around about the middle of next year. All roads point to Labor landsliding into power next year in the federal election. Now, the reason I'm going through all this again today, and the reason I'm summarising the last bit I'm about to summarise, is because of this fact. Labor have a history of removing anything decent for business owners and investors that exist out there, like any laws that exist. They've got a history of getting rid of them or watering them down or whatever. My gut feeling is, given the press that exists, albeit, as you know about press, a lot of it's due to lack of knowledge. They're sprouting off stuff that's not real, but a lot of the press, there's a lot of negative press around borrowing in self-managed super funds, and it's because they don't understand it. When you understand it, it's actually reasonably straightforward when you get to the tic-tacs of it, and incredibly powerful. So the reason I'm highlighting and finishing on this note is I reckon Labor will be in next election. Now, what that means is it would not surprise me if Labor get in and get rid of this real quick because they don't like it. They've shown that they don't like it. So I reckon there's now a window of opportunity of about 6 to 8 months where you have to strike if you're going to. Otherwise, I reckon you'll never be able to do this. I don't think this will ever come back into play. I reckon it was a once in a lifetime opportunity, and I don't reckon any government will ever do it again. Going by my experience over the years and what happens and what gets said and all that sort of stuff. So given that it takes you around about, 4 weeks to set up a super fund and get a tax file number, and another, say, 2 to 4 weeks to set up the Bear Trust and roll over the super fund monies, that's 2 months, roughly, it takes you to set up a self-managed super fund with all the bells and whistles ready to buy a property if you pulled the trigger today. So let's say we're at the end of October now, which we are pretty much. That means the earliest date you're going to have a fund ready to roll is the start of January next year. That then gives you 4 to 6 months to find and settle a property that you're happy to buy. So, because I'm not sure if the election's May or June or July, I'm not sure, I don't know when it's meant to be. I can obviously call it a bit earlier. So if we work on a May election, right, as a rough worst case scenario, obviously I don't know, I'm guessing. That means if you pull the trigger now, you can't buy a property till the start of January. That gives you 4 months to find something and settle it. Now, understand something, lenders like, I think they like to have a 2 to 3 week finance clause, I think, as a rule of thumb from off the top of my head. Obviously, I'm not a broker or a loan provider, but off the top of my head, 2 to 3 weeks. 3 weeks, I think, is preferred for a self-managed super fund property purchase to have a finance clause in your, which of course I would encourage you to put in. Essential, not encourage, essential to have a subject to finance clause put in. I think they like a 21-day clause for self-managed super fund ones. And I think they like 45 to 60 days, preferred 60-day settlement terms, just because there's a bit more red tape and a bit more information for banks to go through to settle these loans. So what I'm really saying is you really got to act now if you're going to do this, because I think the clock's really ticking, and this wonderful opportunity that can massively change your future and your retirement for you and your family. I reckon the days are numbered and the clock is seriously ticking, and seriously consider it, and happy to talk to you one-on-one a little bit more about this if you'd like. And our contact numbers here are 039 787 8906 or customer care at superioraccountinggroup.com. Happy for either myself or Catherine, who is our self-managed super fund guru here, to have a conversation with you about your personal situation and whether you think it's appropriate and viable. It's not a hard thing to work out whether it's viable, and then there's some set parameters that are pretty easy to tick boxes on to know if this is viable or not. And I've covered most of those in this session anyway. Really, 200 grand, having 200 grand in super and having some employer contributions coming in, preferably both of you, would almost be able to get something going in the property space. And then it comes back to what sort of property you want to buy, how much is it going to cost, what location is it, how much have you got in super, and there's a whole lot of things we can then look at. But as a general rule, 200 grand with both you putting super in via your own business or your employers would probably get the conversation pretty close to going, all right, this is doable. Let's quantify it a bit more. And I encourage quantification to a certain level before you go ahead. I normally get figures run by our broker before you go ahead, just to get an idea that it's viable. So with what the lender will provide, plus what you've got in super and holding costs and all that sort of stuff, we'd like to just get a rough idea that it's doable clearly before you go ahead with anything. But then once you go ahead, we'll put the foot down and we'll make it happen quickly. But the clock is seriously ticking. So if you're going to do this, the time is right now. You can't, I don't think you can even put it off much more than a few weeks, because or even a couple of months, because then it's going to be too hard to get it done. So on that note, I want to finish. I want to thank you all for your time, both on this webinar today and the majority of you who will be on later on. Is anyone who's on, do you have any questions? If so, do you want to shoot them through now? I'll give you guys a few seconds. I don't see any questions coming through. So I'd like to conclude by saying thank you very much for giving up your valuable time on this webinar live or at home in your own time. I do appreciate it, and I do value your attendance. I think there's still an amazing opportunity that exists for you guys to massively change your retirement, but you have to act quickly. And if you want to have a further discussion, as I said, please contact us on those details on the screen. And I'd like to wish you all the best in your decision making, and happy to talk one-on-one about your specific situation and how it applies to you, if you would like to go down that path. But I do encourage you all to seriously think about it, and you know, it's potentially game changing. So thanks for your attendance. I appreciate everything. Look after yourselves, everybody. And until I next speak to you, take care.